Hey, everybody. Welcome back to the Real Estate Rundown with Shannon Robnett. Today, our guest is Joe Vera. Joe, say hi.
Hello. Hi, Shannon.
So, Joe comes to us with a background of about 30 years in financial services. And I really wanted Joe to be on the show today because, as everybody is aware, we are in some very interesting financial times. And throughout our history, we've had cycles and we've had sessions and we've had the dot-com bust and we had the great recession of the real estate debacle and everything, and everybody always likes to blame it on somebody. But I wanted Joe to be on the show here to tell us why financing is a great thing and why a good financier is a fantastic asset. So Joe, I want you to just start off by giving us your background and let us know what got you from where you started to where you're at. Take about 5 minutes and just bring us up to speed on Joe's life.
You got it. Thanks, Shannon. I appreciate the opportunity, and I want to say hi to your followers and excited to be here. So, name is Joe Vera. Actually, was born in the Philippines, came to America when I was 3. My mother was fortunate enough. My mother had 8 brothers and sisters. Father had 9. So we were the only family from both our collective families to come to America. She was a nurse and was brought to America during the Vietnam War because there was a shortage of nurses, much like what's happening today, right, with COVID-19. And there's always going to be a shortage of nurses. And so she came to America with the promise of being able to bring her family to America after she spent time in America of about 18 months working in the VA hospitals, which then gave our family the citizenship, green cards, and so forth to get us here. So I grew up in Long Beach, California, and loved California, and went to UCLA, which was my dream school. And there I met my wife, Emily, who actually grew up here in Boise. She went to Capitol High School, graduated, and went down to UCLA. We met.
What year did she graduate?
She graduated 87 from Capitol High School.
Okay, I graduated 91, so she just missed me.
Oh, was it at Capitol as well?
Yeah.
All right, good. She had a younger sister, Sarah Miller, who I believe you might know. So there you go, Emily Miller.
Welcome to the podcast of How Small is Idaho, ladies and gentlemen.
There you go. I guess you can call me. I'm the Kevin Bacon of Idaho, maybe. You are. So Sarah's my sister-in-law. Emily's my wife. Okay. We met down in college. I was in a fraternity. She was in a sorority. And during one dinner when I took her out, she basically told me she didn't want to raise her family in California. I thought she was crazy, and because I love California. Long story short, here I am in Idaho.
Life more than California, Joe.
Yeah, I found. Yeah, definitely. It was the best move ever. Not just obviously meeting Emily and marrying her, and eventually moving to Idaho 20 years ago, raising our 4 kids here. But Emily was definitely a person that still today gives me a lot of perspective on life, because we came from different backgrounds. I'm from an immigrant family, grew up in really kind of tough times, being an immigrant and living in a big city like Long Beach, which wasn't the easiest city to grow up in. I went to Long Beach Poly High School before I went to UCLA, where I tell my kids and the kids that I coach basketball, I also coach basketball, that every day at school I had to walk through a metal detector, so now walking through metal detectors isn't a big deal for me, whereas with other people, they've never seen one or had to deal with it. Now they do when they go to the airports, obviously with TSA, but yeah, every day it was a daily event for me to have to, walk into a school to say, all right, the reason why the metal detector's there is because people are bringing in bad things, and we had to deal with that. And I saw bad things almost on a daily basis. And so that was, I guess, part of what made me who I am today. Going to UCLA was definitely a big part of me. When in my fraternity brothers, I'm still very close to them. It was kind of a neat experience for me. People asked me what I learned in college, and besides maybe some of the fun stuff we did that maybe helped show up who I am today.
That's a different podcast, Joe.
It is a different podcast, maybe during happy hour, but really, what it taught me being in a fraternity, and I don't know, Shannon, if you were in a fraternity when you're in college, there's this thing called Rush where you had to go in and And both, when you're not a member of the fraternity, you had to, in essence, sell yourself as a person, as a good fit to that fraternity. And then when you were in the fraternity as a brother, the rushees would come in and you would have to make a very quick decision. If you read the book by Malcolm Gladwell, Blink, it's that fast filtering system that you kind of build up and generate over time,
Right.
To decide, all right, this person is a good person. I trust him or her, and I want to do business with them, spend time with them. They're going to provide some value to me as a person. And I want to provide value to them to kind of, work together with them over time. And with fraternities and sororities, it's kind of the same thing. You're basically deciding, because at least I took the phrase brotherhood very, very seriously. And some people, they joke about it, laugh about it, and I understand that because, there's some bad stuff out there and some people that are in fraternities and sororities have made some bad decisions. But anyway, so that was, I think, a big part of what made me who I am today, was the ability to market myself to people and speak extemporaneously. Just quickly say, all right, here's who I am, and here's what I'm about and what I believe in. And then B, make decisions quickly with people to kind of decide, all right, this person's really listening to me, they really are engaging, or they're not. And I think the older we get, at least for me, my wife has told me, I've gotten a little less maybe tolerant over time, just because, it's when the older you get, you have more stuff or people you
Right.
accumulate or you talk to. And so I'm having to be a little bit more decisive that way. But bottom line, I think the key thing for me is trying my best with because everyone is compressed with time, to really listen to people and really lock into what they're saying, and then quickly have at least an initial understanding of your path of how to best help them.
Right.
Quickly, instead of doing what typical bankers do, which I call death by 1,000 paper cuts.
Right.
Which is basically, all right,
Fill
they'll ask
out
you
this,
questions.
fill
Yeah,
out
they'll
that.
drag you along.
Right.
Because, bankers love, I joke about it because I've been doing it for so long, because it's true, I guess. We love to take you to lunch and take you out golfing and
Fill
all
the
that,
file.
wine and dine you, until at the end, you know what, we can't help you.
Yeah.
And so I think that was one of the key factors of me learning of how to best, take care of people, and not even knowing I was going to get into the financial services world. And so during college, I started working in a bank. I thought I was going to be an attorney. Realized that the law world didn't fit me when I worked for an attorney as an intern for a bit. Fell backwards into banking as a teller, answering phones for a branch manager in a branch in Beverly Hills. Just because there's an office available there, a job opportunity, and then just kind of worked my way up the chain. By the time I graduated, I became a management trainee for Bank of America down in LA, and then ended up moving to Seattle because my then fiance, now wife Emily, got into the master's program at University of Puget Sound. So we decided to move up there. I joined up with Washington Mutual Bank and started with WAMU and their management training program for a couple years in the Federal Way and Tacoma offices. Then moved to Portland, where I ran branches for Washington Mutual for about 8 years. And then WAMU transferred me, or gave me an opportunity to move here to Boise in 2000 to run the Boise Town Square office for them. Okay. That's what got us to Boise. And after 3 years, WAMU was experiencing amazing growth. That was during the craziness heyday of lending and banking, and everyone thought that it could not end, right, and no one could do wrong, right? And so at that point, the bank was expanding tremendously. They wanted me to move back east. I had an opportunity to move to New Jersey, Chicago, Atlanta. I passed on all of them. The bank at that time then said, all right, if you keep passing, you got to move up to move out. It was like an old GE saying, right? And and so I didn't want to move out, so I couldn't move up. And so I decided to find something else to do to keep me in town, to kind of maybe challenge me more than retail bank management. So I got into wealth management, did some investments, financial planning for a local broker, Bob Rathbone. Did that for a few years, and then missed banking. So go back into banking with KeyBank, worked for Joel Hickman. For a number of years. Joel's a great guy, got recruited then by Washington Trust Bank and Dave Terrell. Worked there for about 6-7 years, and that was a good stint with Dave. And then that's when I ended up going more into the commercial real estate investor world. I was hired by A10 Capital, run by Jerry Dunn and Ken Wilson.
Yep.
And worked for A10 for about 2.5 years, and learned a lot from them. It was a great experience, but that position had me had me travel quite a bit. I was basically, my territory was pretty much the West Coast minus Southern California. I had Oregon, Washington, Idaho, which there weren't many deals big enough to land here in Idaho. So I spent most of my time in Seattle, Portland, Sacramento, Oakland, Palo Alto, the Bay Area.
Let me guess, Emily wasn't a fan.
She was not a fan. And my kids weren't either, although maybe they won't admit it to you, Shannon. But I think they did miss me. I was missing a lot of basketball games, a lot of events. And my wife, Emily, she appreciated the fact that I was working, but I was gone a lot. And so I was on a plane every Sunday night heading to a city, a destination, and then coming home typically every Wednesday or Thursday, trying to play catch up. And it was, initially it was fun. And I like I told Jerry and Ken at A10 when I decided to leave, I learned a lot because going from the owner-occupied lending world and banking to the commercial real estate investor world that A10 provided, working because A10 did the value add non-recourse bridge financing. And so learning that world and how investors think is really where I cut my teeth on and kind of the message that I've kind of carried through into today. And so after a few years of that travel, got burned out, went on, joined a company called Vera Capital, which is a hard money lender based out of Kirkland, Washington. Right now, they're about a $150 million fund. I learned a lot from them. Dimitri Vizis is one of the principals there. Learned a lot from Dimitri. We're still friends, and did that for a couple years and ran their fund here in Idaho. They basically portioned out about $20 million to lend here in Idaho to build their hard money lending business here, and to help them develop and produce the new construction hard money program that they now still offer. Help them with understanding the credit side, leverage points, underwriting, and then they already had the closing documents and such in place to do that. So I kind of helped them develop that, and then led me to now I'm with Finance of America Mortgage. And so FAM is a company backed by Blackstone, one of the largest home lenders, retail and wholesale and reverse mortgage lenders in the country. And they also had a division called Finance of America Commercial, which did lines of credit for fix and flip, new construction, and also did a portfolio of rental property loans as well. And so that was my main focus.
So Joe, when we say that lending, it's very apparent with your resume that you have been involved in just about every single phase of it, and can understand the nuances that are with each part. I mean, so when you talk about wealth management, that wealth managers often look at situations where hard money lending is a great way to build wealth with the security that's backed by an asset. Then you've got the conventional financing that comes out of a bank of Washington Trust or WAMU or whatever. And now you're back to the retail side with Finance of America.
That's right. So, thank you. Yeah.
So you kind of went in one door, went through every aspect of it, and back out essentially to the retail side minus the branch.
Right. That's correct. And actually add to that too, Shannon, if I may, what the background that you mentioned, especially in the financial services or the financial wealth management world. So I did have my Series 7 and 63, 65 licenses. Has helped me kind of better understand and then educate my clients on what happened to the mortgage industry, during COVID and the volatility that took place with mortgage rates. Understanding that the Fed lowering rates to zero didn't really have an impact on rates like a lot of people thought it should. It was more so based on the MBS market and the lack of liquidity in the MBS market that caused, the rates actually increase after the Fed announced their rate decrease. And then eventually now the Fed has performed better for the mortgage industry to where they stabilize things and rates then followed them and decreased over the last.
The other thing that everybody failed to realize with that whole scenario is that just because the Fed dropped the rate, you still had to get somebody that was willing to invest in 0% paper.
That's exactly right. That's exactly right. People don't understand the back end. You're right, exactly right.
At the end of the day, you write all the mortgages you want, but at the end of the day, you've got to sell that to somebody. And last time I checked, nobody's in it for free.
Right. Yeah. Right. Exactly.
So that is so what is it that, what is it that you've seen with the finance world that has kept you in it this long? 30 years that's a long time in any business, but finance is always changing. It's always evolving. What's kept you here for 30 years?
Well, I got to say one, and this is an ongoing joke that a lot of my friends have heard. At UCLA, I studied political science. And so what they tell people, that poli-sci majors, you're either teaching or you're unemployed. And so I guess for me, it's a necessity. I got to go into this. And so this is what I know. And trying to do something else, if I had a CPA like background or a CPA degree or some kind of, true finance degree, maybe I'd be doing something else. But that is definitely, partly maybe a joke.
Yeah.
The fact that it's a necessity, but B, what's kept me around for so long is the reminder of, I think, that this business of what we do in different capacities and how we're about to do things really is about helping people. And I know it's overused and it's corny and it's trite, but when you really do, I think, dig in deep into it and really ask the right questions and follow through and do what you say you're going to do, or at least, help people through these, especially now through these challenging times, like with a basic refinance of helping them lower their rate and an extra $200 a month is huge for people. Working with clients that have multi-million dollars worth of a portfolio of real estate, and then turning around and help them now with just a basic conventional refinance, that extra $200 means a lot more to them than you'd think. And then so it's really helping people. And then B, what's really kind of keeping me motivated now are really, Shannon, are situations like this. I think over the years when you've done enough, like you and I have in this business and seen a lot of stuff, now I see it as my task or my calling to really just try to spread the word and help people out and share through education. Hopefully it generates business, but if it doesn't, that's fine. Life goes on. But it's really educating and motivating people to stick it out and to hopefully do the right thing and move on.
Well, and Joe, we saw when we want to look at an example of what you're talking about, when we saw the mortgage crisis that came out of 2007 and 2008, which, as we know now, history has taught us was created by a lot of people trying to make their money, not really caring about yours. They were convincing you that a negatively amortizing loan was a good thing for you. Right. You deserved a $500,000 house on $40,000 a year in combined income. A zero doc loan was a great thing, and the reality was the only thing it was good for was they got a commission out of the deal. They got paid on it.
Right.
But what we've seen, and this is what I've known about you, Joe, is that what we've seen is that those people got out of the industry in 9, 10, and 11.
Right.
But as we know with your resume, as I know, and the listeners are figuring out, you didn't get out of lending during that time period because there wasn't a stint where you became an actor or, you
well, no, this face, Shannon.
Yeah, my mom says I got a face made for radio. Why are you doing a podcast? But anyway, gotcha. But, and so I completely agree with you. Now is the time. The economy is doing great. There's been some things that came out of 2008 that changed in lending that helped make it safer, but there's still bad actors, right?
That's correct.
There's
That's
still
correct.
people out
Always
there
will be.
selling for the sake of the sale, for them, what they get out of it. But really helping people to understand that if it wasn't COVID, it was going to be something.
It's going to be something else. Exactly.
And
Right.
how do you really position yourself to take maximum advantage with maximum protection to make sure that you can live?
Right.
And that's what, Joe, I see you doing in your outreach in the community and things that you do to really truly educate.
Yeah.
You used when we were talking before the podcast, you were telling me some things about bankers that were not really flattering,
right?
But not really true of all bankers.
No.
But the fact that I really see where you're wanting to educate. Why? And so first of all, let's start with this educational question, because when I grew up, if you were working with a hard money lender in the 90s, you were in deep caca.
Right.
Because the term kind of had a connotation that it was a bad deal.
Right.
But you worked with hard money lenders.
Yes. Worked for them. Yes.
For them.
Mm-hmm. Yeah.
So there's a time and a place for that. What is the advantage of working with a hard money lender?
And it's a great question. And I believe it is. There's two reasons why hard money lending exists, and it should continue to exist. Number one, there is the necessity part of it, because hard money lending is typically driven on short-term money. And let's be honest, banks, financial companies do not like short-term money because they cannot then turn around and sell it under the secondary market. Short-term money, it moves too fast. It's paid off too quickly, and it is seen as maybe a higher risk type loan. Therefore, the secondary market for it on a national or global level just really doesn't exist. And so A, banks don't like doing that portion, but then B, the real reason why I think you want to use a hard money lender is velocity. It's how quickly you can get your money, get the deal done, get the funds you need for rehab if it's a rehab. And then after the rehab is done and the money is there to complete the project, you're in and out of that project in a matter of days and weeks, if not months, because the longer the term, if it's a longer term type loan, the longer the term is tied to the duration of amount of time it takes to qualify you for a loan. So if you're looking for a 30-year fixed rate mortgage, it takes about 30 to 45 days to process, because there's a lot of steps and factors built in, like appraisals, like title searches, income documentation, all those things that are needed to satisfy not just the bank or the lending company, but to satisfy the secondary market behind it, so that when they package their notes, and you mentioned this, you talked about it very, very well and eloquently. 2007, 2008 taught us a lot of lessons as to how to do things right and not do things, and make sure that we don't do the bad things again, or the wrong things, which is no documentation, and which is negative amortization type loans. And the reason why any negative loans worked or existed is because people really couldn't afford to pay their mortgage based on documented income from the get-go. So it was basically it was a bad deal. It was a ticking time.
And the other thing too, that Joe, that if we look back at 2007 and 2008, we had a 10-month supply of inventory in the market.
100%.
So we had to keep the market churning. Nobody wanted to stop. The mortgage lenders didn't want to take a break. The builders didn't want to take a break for 6 months while we sold us off. So they came up with another product,
Right.
And
exactly.
And so I was just talking with a guy, Ryan Morty, who was a fix and flip guy out of Florida, and he was talking about hard money lending, and the velocity point was really what stuck. Having to be able to do something in 2 weeks, having to be able to, and you only need the money for 90 days or 120 days, and by the time you go through, WAMU, and the death by 1,000 paper cuts, I like that. I'm going to use that.
Please.
you're so far down the line that you can't take advantage of the deal. But you need somebody that is explicitly in tune with the market that they're working in.
That's exactly right. And I think, what also happens, when you try to get long-term debt to utilize for a short-term project or deal, the ability for that loan or that financing to really match what you need. And because there is a lot during that time frame of 30, 45 days of processing. There's another phrase that we use in the commercial real estate and also in the financing world, which is retrading. Terms change over time, and so from a investor or builder standpoint, the biggest risk, one of the bigger risks you have when you're looking at a deal or project is having that pro forma change almost midstream, right? To
Yes,
where
sir.
you thought you had margins, and then it pro forma'd out. But then the bank says, no, you need to have more leverage or less leverage, a higher rate of interest, or we can't do the loan at all. But then what happens in the end is that you end up without the loan, or the loan changes and your pro forma changes, and then it might screw up your plan, your partners, and everything else going forward, right? And so I think with hard money lending, what it does, if you have a good hard money lender, it gives you somebody that is an assurance to say, all right, I'm going to get you the money in 2 weeks, right? Or less sometimes, which is pretty amazing.
Yeah.
Here's what the rate's going to be. And they have nobody else to answer to other than themselves, typically, because they're either their own money or a buddy's money or a pool of money that they kind of manage. And you're talking to the decision maker. You're talking to the actual lender. Whereas, as we know in banking, it's much like buying a car, right? You're talking to a lender like, all right, well, here's what I want. And the guy or gal, we leave for about 15 minutes.
Talk to the credit manager.
Right, exactly. Yeah, exactly. Come back and we can't do that for you. Sorry. Well, who'd you talk to? I mean, let me talk to that person behind the desk or behind the window. And so it gets frustrating. I mean, and I understand that from a client's perspective, and then that could happen still with hard money lenders too, right? Because the business from when it first started in the mid '90s to where it is today. It has evolved to where it's become a lot more industrialized, become a lot more of a true asset class for investors out there.
Right.
So it's a lot of companies like ours. We invested in Finance America Commercial. We bought two companies, JBI out of Chicago, and I forgot the name of the company, Joplin Capital. I believe Joplin Capital out of Chicago and JBI out of North Carolina combined them to create Finance America Commercial. And so, it's become a lot more mainstream per se, but at the end of the day, it's still kind of the same principles, right? It is more asset driven, more understanding of the real estate versus the client. But the farther upstream you go with the amount of either dollar amount or deals or history that this client has, they should demand better cost to help their pro formas. But what happened recently is that middle tier market evaporated during the start of COVID-19 and the velocity, or not velocity, but the volatility that took place during that time.
Yeah, evaporated is a good term because it's now just become a mirage. Did we really even see that? Because it's not that the pool has gotten shallow; it's gone away.
It has.
And that's really put a lot of people in an interesting spot because they've got deals that are ready to go. They're all teed up. They've got they've got every piece of it except for this this hard money, this top of their capital stack, and then all of a sudden they're back to square one trying to refigure this out.
That's right, and even harsher than that, Shannon. What I'm hearing, and you probably heard it too, some builders that have a lender, that maybe wasn't well capitalized or whatever the situation is, right? Because we don't know what's happening behind the scenes, but there's some lenders that are stopping to pay draws, midstream, mid-project, because they're in a capital crunch, right? So it's challenging. It really is.
Yeah. No, and Joe, that's that's back to what you're saying is the relationships that you're building. There needs to be it needs to be more exploration on a borrower's point of view that more than just will you approve me?
Yeah.
It's will you be able to continue to approve me?
Yeah.
Are we building a relationship that you're going to be able to participate in when I want you to, because we all know the bank's question,
Yeah,
only as good as your last deal. I
that's
mean,
right.
you know,
That's
but
right.
how many borrowers actually take that scenario to the bank? You know,
Right. Yeah, right.
and
Yeah, not many.
so Joe, with Finance of America and what you're doing there, that's the retail side of it.
Mhm.
How can people? What should people be looking at in this COVID environment for from their financiers,
Yeah,
from their lenders, or if they're looking to do a loan, because we know real estate's still transacting.
yeah.
What is it that people need to be keeping an eye out for in the environment we're in with their retail lenders?
Gotcha. And so I think one of the key things, and maybe they already have, just because rates have been low now up and down, for the last couple of years. I think one of the things that folks should be focusing on, not just during COVID, but post COVID, is whatever, regardless of what you believe, whether or not COVID's going to, after the lift of COVID-19, when we work out of the fog, that it's going to create maybe some pent up demand uh, in our market, particularly in Boise, that's
Right.
going to lift things
Definitely.
again.
Definitely.
And maybe the short term, let's say Q3, Q4, 2020, maybe that does happen if you are in the investment real estate world, or if you're just basically a person looking into it, or you're just a guy or gal that has a family that's looking to help manage their finances better. So that there is that could take place, and the economy does recover to a certain extent because of what the Fed has done with their stimulus packages and the CARES Act. Maybe that does get us back on track. There's also the other end of the spectrum, which I'm sure you've heard or talked about, where it's going to be bleak and dark for not just, maybe there is a little bit of a bump post COVID because of good feelings, but what the Fed has done is set us up for more challenges down the road, right?
Right.
There's not enough. The GDP doesn't give us enough margin to repay the debt that we've added to our balance sheet as a U.S. economy. And so with all that stuff, that is a lot to think about.
Yeah.
It goes back, I believe, which I know is going to sound again trite and overused, but it is really people really focusing on their family wealth and their family situation first,
Right.
to try to minimize their expenses. And I do think, and I know this is definitely plugging things, but have you really looked at what your recurrent rate is on a mortgage, both if you have an existing home, if you have a second home, investment properties, so on and so forth? If you looked at your portfolio to really try to take advantage of the one thing that is a good thing now that COVID-19 did create for us, which are rates below 4%.
Right.
On a 30-year fix. Investment property loans are definitely the fives, because we just talked about the risk challenges of loans as you go farther up the risk chain of the types of loans we have out there and the investors that want to buy them. So investment property loans are definitely in the fives. But on your current mortgage, if you're able to qualify with good credit and income, can you refinance your loan before 4% and really get a good solid rate, or either 30 or 15 years, or actually below 3%, to really help you with either cash flow or paying off your debt quicker, and not just your mortgage debt, but can you wrap in other types of loans or debt to consolidate, to make that make your balance sheet more attractive and improve your balance sheet over time, even in a potential downward economy. So it is, I think, refocusing on your it's really like what we're doing now with with the shelter in place or stay at home orders. It's really helping us, or making us relook at ourselves and what we have and what's important, versus looking outward and trying to see what's out there. So I think that is the first step. The second step, I do think, which I think is important, is then, as you're looking inward, really looking at the folks that, like you said, which is well said, that are going to be around for a while, right? That really do like and believe in what they do, and are going to make it through this. Because as you know, and I definitely know, much like 2007, much like the dot-com bubble, in 2000, and obviously Black Monday back in '88, these times really do end up, unfortunately, or maybe fortunately, depending upon how you look at it, weed out the folks and people and industries and businesses that probably should not have been in that industry or that space to begin with. And
Right.
so it's folks really trying to find a really solid, trusted advisor to really walk them through it. And I think what happens now, which is challenging, is that clients and individuals and businesses are really, they're looking for answers, right? They're grasping at things, and the internet only clouds, or it only confuses the situation of the equation.
Unless, of course, you're turned into this podcast and then it's providing
right.
tremendous clarity and
If they're talking to you and me, right? They're good. It's just give Shannon or Joe a call. We'll take care of you.
We'll take care of it. We'll tell you
we're good.
Certain it really isn't.
Right, exactly. but there's going to be people that unfortunately try to take advantage of this situation as a marketing tool. And are they really there to really talk about their situation on their basis, on their terms, versus leading you down a path that really does benefit more the advisor, and benefits the company that the advisor works for more so than what they're dealing with. And what's been interesting over the last few weeks, because of the fact Fan Commercial has put our lending to investors and builders on hiatus, I've had a lot of calls with clients that have been challenging to say, look, A, I can't offer you a loan now, and B, if I could offer you a loan, this might not be really the right time to do it.
Wait, Joe, you're actually telling people that they probably shouldn't borrow the money? As a lender, do I really hear you saying that?
Yeah. I mean, again, maybe it's age. Because again, this, I get paid on deals that I close. And I've told this to a lot of clients.
Sure.
So as we structure a loan, and based on pricing, based on terms, based on things that they need, or like I said, we can't offer a loan, but looking at the deal they're looking at right now, it's a question of, all right, let's say you wanted to do a fix and flip or new construction deal. And right now, the real question that I have, that we should have, is can we really feel good about what this value is going to be, the after completion value down the road? And so in some cases, if it's 50 or 60% leverage, this is a good deal. You have enough margin in there. You have enough. Yeah, you've really done your work to where figuring out, and then based on comps, even with the 10, 15, 20% haircut, right, on values, it might happen or might not happen.
Right.
So it's really looking at deals more stringently now. And I know this probably could be affecting me, which I guess is fine. That's the way life is. But really, it's really looking at your deal to say, if you're basing your income on growth and momentum, that's definitely not going to happen now, right? If you're basing your deal on true fundamentals,
right,
and making sure it makes sense, and either it is a fix and flip. Again, we're not lending to that, but I'm still helping clients out with numbers and kind of talking through the potential financing of that. Or if it's a BRRRR or buy, rent, a refinance and so forth, are the rents justified? So that, let's say 6 months from now, if unemployment does continue to increase, if the economy does not come back, and you have to either decrease rent or offer any kind of abatement or some kind of incentive to keep renters there, do you have enough margin there to where you're not writing checks on a monthly basis for that investment property?
And that's where I've heard a lot of people, in the value add market, especially in multifamily, where they use the term forced appreciation.
Right.
I've never really liked that term, because really what you're doing is you're saying the fundamentals that are in the deal today have to be changed for me to be profitable.
Right.
And what can I do to force that? This next 24 months or 18 months isn't that environment that you want to be in, where you're trying to force anything.
Agreed. Yeah. Another phrase that's used quite a bit is rent lift, right? Is the understanding that rent.
Another one, we're old. Speaking of deals or terms, I heard somebody the other day said house hack, and I've heard house hack a lot. And
Yeah.
And so I said, what do you mean by house hack? And they said, well, you buy a house and you rent out 2 rooms. And I said, man, that was called being broke when I was your age.
Right.
I mean, you had roommates because that's what you needed to pay the bill.
Right.
If
Right.
you didn't have roommates, you didn't have you couldn't afford the rent on your own. So
Exactly.
that's what I you got to appreciate millennials, because rent lift, forced appreciation,
Oh yeah.
hack, these are their terms. We would have never come up with those. We called it
No.
broke, hopeful,
Right.
I
Yeah,
wish
right.
it would.
Right.
What's your marketing strategy? I'm going to pray about and hope it goes up.
Right. Exactly. Yeah. It's the millennials are definitely better at branding
Yes, yes,
and
for sure.
wording than we are.
Probably because their whole life they've had everything sold to them.
Oh well, you're right. Or every day they're being sold to
Yeah.
on a handheld, right? So
Yeah.
it's all about branding and words.
So, Joe, looking at the next 12 months, and knowing that nobody's got a crystal ball and
Right.
and nothing is certain, especially in this time of uncertainty. But it's funny how quickly we came from a time of certainty in January to this
Right.
time of uncertainty.
Yeah.
Just 3 months removed.
Yeah.
What is going to be your takeaway for my listeners that you can, from a lending perspective, what is the thing that every single listener can be looking at in the next 6 to 9 months?
That's a good question. And I think the next 6 to 9 months, I'll break it up in the next 30 to 45 days. I think what they should do is pretty much what banks are doing now with their portfolios, right? Is they're looking at their portfolios. And so the borrowers should, if they own rental properties or they're mid construction or mid rehab on a fix and flip property, they should really take a hard look of what they own and what they have to really make sure that they know exactly what they have and that it's actually broken down into some form of a spreadsheet or systematic kind of thing that they look at to manage that. I think they really need to manage what they have. They need to make sure that they understand, when leases expire, if renters are asking for abatement, are you really working that, manage that? Or if you're working with property managers, are you talking to your property managers on an ongoing basis to kind of check and make sure that rents are being paid, that the project or that the facility is being managed and maintained? I mean, really trying to manage and work on the stuff that they currently have now.
Right.
And then if they do come across a deal or an opportunity in the next 30 to 45 days, kind of the same thing of looking and seeing what you have, make sure you really have people in your corner. And I think people are other investors, a financial advisor, and a lender like myself, and a realtor that they trust.
Yeah.
I kind of say, all right, here's the deal. Well, hey, here's the stuff in my portfolio. I want you to give me a true, honest assessment of what you think these values are today and what they might be, and then do a 20% pro forma decrease and just kind of a stabilized, maybe just as is pro forma as well. So you have a worst case scenario and a current scenario. Really manage that.
So you're talking about doing a financial statement or a financial picture in time and projecting forward in a good way and a bad way.
Yeah.
So that you're able to anticipate when it comes, it's not a surprise to you.
That's exactly right. Right.
That's some fantastic insight, Joe, because then as things start to unfold, you have a plan if it goes this way.
Yep.
You have a plan if it goes that way.
Right.
And you can see how you're going down one of two paths. Because I know if we look back at 08, and everybody keeps comparing this to 08, and we know that this is not even close to the same as 08.
Big difference.
But the thing is, 08 was a lot like the Titanic. Everybody was listening to music and watching the band play and having cocktails until she slid right under the water.
Right.
Yet what you're saying is to be proactive and know where your water level is, where is it time to get out. If it dips below this point, if it heads this direction, my realtor's already up on it. I already know that I can get away from this before.
Right.
Joe, that's some fantastic information. And that's, I think, something that I want my listeners to take away is that doing a maybe even just a biannually assessment of what
Right.
you have and how what you have is performing, because I know a lot of times we don't look at how what we did performed until we've sold it or until it's over with. And then we look at what we could have corrected, maybe doing some interpretation of that financial picture in the interim is
Right.
a good thing.
Yeah.
Joe, one
Yeah.
last thing I want
If I
to,
could add one more thing too, Shannon,
yeah, go ahead.
to that. And so as you do that assessment, and I appreciate you Dave basically saying exactly that. The last thing I think people should try to do if they can is revisit their credit opportunities with their bankers. If it's, home equity lines of credit, if it's, any kind of credit capacity that they have access to, and then B, try to gather and try to retain and try to get as much cash as they can.
Yeah.
To
And
prepare for
that's
themselves.
something that
Yeah.
I remember I was told early on and it was oddly, it was by a banker, but they said, we will always loan you money when you don't need it, and we never will loan it to you when you desperately need it. So
That's correct.
when you're in the financial position to be asking, whether you need it or not is the time to ask.
That's right. Exactly.
Because as we head into these times, everybody might be fine today, but if today continues for 6 more months, how depleted will your cash reserves be?
Exactly.
And at the point that your cash reserves are depleted, they don't usually like to loan you money.
Yeah, right. Right, exactly. And can you utilize that cash if you're in a good position to really improve your portfolio and grow your portfolio at a lower basis, right?
That's exactly right.
Than what we've seen.
Exactly right.
So anyway, thank you.
Well, hey, Joe, I want to thank you for the time that you've spent with us this morning. I really want to thank you for your insight into, just what you can do already here. We're sitting right in the middle, hopefully toward the end, right, of COVID, but we're sitting here. The cake is baked. We've got to deal with it. But I really, really appreciate your insight on how listeners can improve their position as they sit today, and how they can also improve their look going forward. And at least if it doesn't turn out to be better, at least they're not completely flabbergasted and surprised.
Right. And Shannon, it's been a pleasure and definitely an honor. And I appreciate the opportunity, and I look forward to more conversations like this in the future.
Yes, Joe, and I really do appreciate your time. We will be talking with you soon. Thanks, guys, for joining us on the Real Estate Rundown. We'll talk to you next time.